New York City Fire Department Pension Fund Investment Meeting. Today is 12/7/2012. It is 20 minutes of 10. We're in New York City Comptroller's Office, 1 Center Street, room 530, New York, New York. Can we have a roll call, trustees, please?
Ms. Janice Emery?
Here.
Mr. Larry Schloss?
Present.
Mr. Justin Holt?
Here.
Mr. Steve Cassidy?
Mr. Slevin has Mr. Cassidy's property.
And Mr. James Levin?
Here.
Mr. Robert Straub?
Here.
Mr. John Kelly?
Mr. Straub has Mr. Kelly's proxy.
Mr. James McGowan?
Here.
Mr. John Dunn?
Here.
Mr. James Lamonda?
Present.
Mr. Sean O'Connor?
Here.
Commissioner Douglas White?
Here.
524 votes in the quorum. May start the meeting.
Performance reviews.
SEMA is on her way here, so let me see if I can jump around the order just a little. Let me give you a quick update. That might be her there. Can someone help her with the door? That. Yeah, why don't you start? So let's go back to the quarterly performance reviews.
So this is for the full-time fire pension fund. I have one extra, which is the full fire pension quarterly report.
I think I got it. Everyone okay?
For the fund.
Yeah. Quarterly. Yeah. Okay, so the September quarterly report, as we've gone through over the last few months, you've seen that the numbers have been pretty good. In a short while, Larry will go through October. In short, the quarter was good for a couple of major regions. The ECB in Europe and the Fed in the U.S. continued their market interventions. This had a very positive effect on the capital markets. In the U.S., the Russell 3000 was up over 6% for the quarter, but for the year was up over 30%. For non-U.S. markets, the non-U.S. equity markets, the results were even higher. EFA was up 6.9%, and emerging markets nearly 9%. Fixed income was also up. Investment grade fixed income was up because on the government side, obviously the Fed buying helped, and high yield was up as investors continued to look for yield. And overall, it was a good quarter, and you're going to have a hard time finding a negative number in the report. In U.S. equity, value did a little bit better than growth, and large cap a little bit better than small cap. If you turn to page 8, the overall fund returns are shown. The fund was up to, I believe, an all-time high of $8.6 billion as of September 30th. The return for the quarter was a strong absolute return of 428. It was behind the benchmark of 471. And you'll see the higher bars for the one-year number of 1707. That was also behind the benchmark. We'll go through that in just a little bit. For the 3-year number, nearly 9% behind the benchmark. The 5-year number includes 2008. But I also want to point out the 10-year number of 8.5% is a very strong return. And I'm not sure if the actuary is looking at me with daggers or kindness in pointing out that the 10-year number is over 8%.
It is a good thing to see, but it is not evidence of future performance.
Of course.
Where have we heard that before?
If you turn to page 10, we have the pie chart that shows the asset mix. We have lots of different colors because we have lots of different asset classes. There is a new asset class that did not appear previously. That is on the approximately 11 o'clock side. It's what appears to be military green. It's bank loans. Bank loans were funded in August and September. We will have performance starting next quarter, the quarter after, as we just started funding. If you look at the bottom, you'll see the weights versus the limitations as far as the rebalancing ranges, and everything was in policy except for TIPS, which was, as Larry will show soon in October, in policy. So bank loans are new. Everything's within the ranges. The next few pages show attribution. Much of the management effect that you see that's negative is due to private equity timing differences and underperformance. Allocation effects for the year for the quarter are very minimal. For the year are mostly due to earlier in the year when we had high levels of cash in the portfolios, as we described previously. Unless there are any questions, I'm going to turn it over to Seema for a summary of equity.
Thanks, Martin. If you turn to page 21, this shows your U.S. equity asset allocation. And I'll just point you to a couple columns here on this page. The index return, the actual return, and the difference. As Martin already mentioned, the U.S. market had a very strong quarter. If you just check out the Russell 3000 Index Fund, which represents the market, up over 6% for the quarter. And then if you scroll over to the difference column, a couple standouts for FIRE. So on the active side, so small cap active outperforming by over 100 basis points, mid cap active outperforming by, again, over 100 basis points, and then mid cap active as well, outperforming by over 100 basis points. I also just want to point out the last row there, the emerging managers outperforming by 72 basis points. You might remember that we switched the mandate to an entire Russell 2000, a small cap mandate, and that occurred as of June, so we got a full quarter. So it's just nice to see that trend. Hopefully that will be a trend and keep going. If you turn next to page 28, this is your international equity allocation. And again, I'll point you to the three columns, the index return, the actual return, and the difference column. A couple things, again, Martin already mentioned, but you can see here that, again, the EFA passive, that row, so the EFA market's up close to 7%, beating the U.S. market in the quarter. And then if you scroll down a few more rows to the passive EM, you see it's close to 8% for the quarter. So very strong numbers for equities in the quarter. If you just go to the difference column, I just want to highlight one thing here, which we will discuss more in executive. But under non-U.S. activist, you see a number here of minus 400 basis points relative to the benchmark. Something we've been looking at and working on, and we'll have more to talk about later in executive. If you just turn to page 29, there are just more details on EFA. And so you can see in the trailing 3 months, the purple bar is the FIRE portfolio, the yellow bar is the index. So basically in line with the index for the trailing 3 months, fiscal year to date. But as you look out further, you can see, again, how your EFA portfolio had done quite well relative to the benchmark in the trailing 12 months, trailing 3 years, and even in the trailing 5. And what you might remember also, we completed the EFA search. So we added a couple of new managers, we reallocated a bit of money, and we would look to see the benefits of that going forward. If you next turn to page 34, that's your emerging markets detail. And again, the purple bar is the FIRE portfolio, the yellow bar being the index. So you can see in the trailing 3 months and fiscal year to date, you're outperforming the index. You look out in the trailing 12 months, you're doing that as well. And the emerging manager search that we completed earlier in the year, so you're seeing the benefits of some of those newer managers that we've added to the portfolio and the reallocating that we had done. So that's good to see there. And then finally, if you turn to page 36, this is the hedge fund portfolio that we continue to build out. So there's not a lot of data yet really here. But in the trailing 3 months, fiscal year to date, you can see the blue bar is our portfolio. And then the two benchmarks that we talk about. The one-year T-bill plus 4% is a more of a longer-term type benchmark where we would look at it over a market cycle, which is 5 to 7 years. But the HFRI fund-to-fund composite plus 1% is the one that we've been focusing more on shorter term. And so roughly in line with that benchmark. If you look out in the trailing 12 months, we've only had the direct managers as of January 1, and we kind of staggered them through the year. So you're not seeing a ton of data there and the positive performance that we actually have generated with those direct managers. But later in executive, we'll walk through some more of those performance details with the hedge fund portfolio. And now I'll turn it back to Martin.
Thank you. If you turn to page 38, you see a summary chart of fixed income, which represents 34% of the total fund, nearly $3 billion. Nearly two-thirds of the portfolio is in the investment-grade Core Plus 5 program. That program is broken down further on the following page, and it represents 19% of the total fund. You'll see that on the overweight, underweight column that we are underweight government sector, as we have been for some time, and we're overweight credit. You'll note also that the policy weights, mortgages and credit are both nearly 40%. It's a function of the universe that mortgages have been coming down and credit has been going up. The good news is that all of the sectors outperformed except for Treasuries, which was down just 2 basis points. Treasuries had the lowest return, so the underweight helped. Of the 11 managers, 7 outperformed, and of the 4 that didn't outperform, they were very close, so it was generally a very good quarter, as you'll see on the next page. The program's returns for the quarter were positive at 248, ahead of the benchmark of 204, and for the year, the returns were over 7.5, over 100 basis points ahead of the benchmark. Similar numbers for the 3 years, except it was over 8% for the 3-year number. And for longer term, the benchmark was, the program was ahead of the benchmark, and the program returns were in the 6 to 7% range. The volatility has come down, and so the 3-year number of 8% was achieved with 3% volatility. So it's slow and steady for the Core Plus 5 over the last 3 years. Page 41 shows tips. Managers were slightly ahead. 2 of the 3 managers were ahead of the benchmark. The return was 219. For the year, the return was a very strong 911, and for the 3-year period, this return was 937. Both were slightly ahead of the benchmark. While we have not experienced inflation, the returns are due to the duration effect. Tips have high duration, and interest rates have gone down, and therefore prices have gone up. High yield, we did a transition. And despite that transition, we were right on top of the benchmark returns, returning over 4%. For the year, you see very strong returns. And in fact, going out 10 years, the returns are over 10%, 100 basis points ahead of the benchmark. So high yield has been a very good program for FIRE. Convertible bonds are on page 43. The returns were very close to the benchmark, returning nearly 4.5%. For the quarter, and for the year returning 14.55. That was behind the benchmark, but each of the managers generally were ahead of their benchmarks, and that's the purple line. We now have a 4-year number, and the return is 9.8%, behind the benchmark of 10.79. And finally, opportunistic fixed income on page 44. The return was over 3% for the quarter. For the year, 5%, and 3 and 4 years, you see the numbers are in the teens, ahead of the 10% benchmark, and close to the J.P. Morgan plus 3% benchmark. Unless there are any questions, I'm going to turn it over to Kathy for ETIs.
Just a quick question. Asset allocation is 70-30.
Asset allocation is a little bit less than 70-30.
I'm sorry?
It's closer to 65-35.
66-34, as it is now, right? Do we, I mean, obviously it's not a mandate that we have to be at 70-30, but it seems like fixed income right now is, the returns are not that good. Will we do better to get more invested in equities?
So,
to get closer to that asset allocation? Or?
That's an excellent question, and I would like to turn you to earlier the asset allocation pages, I believe on approximately page 10.
There's a question here.
And Larry may talk about this a little more, but on page 10, you'll see how we're positioned, and we're positioned exactly as you just described. On page 10, you'll see on the left, the green bar, we're overweight equity, U.S. equity, and in the middle, we're underweight the Core Plus 5 and tips. So, yes.
You're doing exactly what you just said, John.
I'm sorry, I didn't hear you.
We're doing exactly what you said.
Okay, great. Thank you.
ETI portfolio outperformed its custom benchmark for the quarter and for all of the longer periods. Your collateral benefits are in the large agenda in the public. I don't know if you do, but the large book, starting on page 6. And they we continue to make investments in New York City. I want to draw your attention to the AFL-CIO Housing Investment Trust and let you know that they had established a 10-year commitment to their HIT Home program, which was a program that provided low-cost, sensible mortgages to New York City union members and municipal employees. And that program is ending, and in the life of it, 181 fire members received mortgages through this program. We are currently in discussions with the Housing Investment Trust to establish a HIT Home 2, which can hopefully be responsive to homeowners affected by the hurricane. Any questions?
Hi, we're going to hit the highlights of the real estate portfolio for the second quarter, and it begins on page 16 of the board book. Yeah, the big book. Page 16. Good news for the quarter. The fire portfolio had a quarterly return of 2.6%, which was 30 basis points above the benchmark, which came in at 2.3. Real estate is moving in the right direction in terms of the recovery. Fundamentals are good. New supply is low. People can still buy deals below replacement cost. Occupancy is going up across property types, and investors are out there seeking yield. If you look at the graph at the bottom, it shows you the performance across extended periods. Fire is in blue. You can see that for the quarter, I mentioned the 30 basis points outperformance. Also for the year, slight 10 basis point outperformance. Also for the 3-year, a 40 basis point outperformance. The outer years, you can see the impact of the global financial crisis, but I guess the point here is that we are moving in the right direction. We made some great selections recently. For the year 2012, we have about $50 million in new real estate commitments. Are any questions?
Great, so I'm hopping into the private equity second quarter review, page 35 of your book. So for the highlights, again, you have about 128 partnerships in your funds in your portfolio, representing 85 partnerships. Altogether, it's about $1.2 billion in commitments. Page 35. And then in terms of total contributed capital, $722 million for the quarter. And distributed capital, which is important because capital coming back to you, is $410 million, up from the previous quarter by nearly $30 million, so that's positive direction. And the market value also increased.
25. John, 25. 25.
Oh, sorry, 25. It's that E on the way. Sorry about that. 25. So yes, your capital coming back to you is $410 million, up by $30 million from the previous quarter, so very positive trend. Also, you'll see in the gains and losses section for this table, you're up by you have a gain of $224 million. It's up by $5.8 million from the previous quarter, and that's mostly attributed to positive performance from your mid-market buyout portfolio. So very good news there. In terms of your total value multiple for the quarter, and since inception, you're at 1.3 times. And then your IRR since inception is 9.8 times, down just slightly by 25 bips from the previous quarter, but pretty much at par. And then if you look at the next page, you'll see against your benchmarks, you're at par with the Russell 3000 plus 300 basis points, which is positive, and you've overperformed or outperformed the Thompson 1 median by 360 bips. So it's very, very positive movement there. And then slightly below the Thompson 1 by 180 bips, but in terms of your policy benchmarks, you're doing very well. And that's it.
Perfect. Any questions on the quarter? Okay. Let's move to the smaller monthly. So we'll get you from September 30 to October 31, I guess. And I'll give you a glimpse into November and December. I guess the quickest way to say this is probably, if you look on page 39 of the monthly numbers, so what you see on the far left-hand column is that the equity markets went down in October. And if I pull it out to November, after the Obama re-election, the markets also went down, but they've since rebounded back up. So if you said, where are we now? Actually, let me take you first to October. So if you look on 39, as I said, the stock markets went down, the bond markets kind of stabilized a little bit. The net impact of that was on page 40. On the far left-hand column, we lost about 30 basis points, so we're kind of ended October about up 4% for the year. We made most of that back. We're probably up a little more than 4% through November. To the question that John had before, John, if you go to page 35, so how are we sort of set up? Because it really hasn't moved that much since this October number. The green bar on the far left is U.S. equities. So we're over-allocated. We're inside the range in everything, but we're over-allocated U.S. equities on the theory that the fiscal cliff has people worried. The fiscal cliff will get solved one way or another. Well, I'm not a bookie, so I can't tell you if it's before the end of the year or the week after. But at some point they figure it out. We presume there'll be a good rally after that, as well as the economy seems to be pretty much on the mend. Housing starts are up and things like that. So we're leaning into equities, particularly U.S. equities, and as a result, we're under-allocated. If you look at the dark blue, what I'll call the insurance policy, which is core plus 5. To your question before, John, on page 36, if you look all the way at the top, two numbers, the adjusted policy. Adjusted means, for things like real estate where we're not fully invested yet, the adjusted policy is 64.3% versus 30 in equities versus about 37% in fixed income. And if you look at the actual, again, we're 66-33, again, leaning into equities and away from fixed income. And most of the fixed income is in higher yielding things like high yield bonds and leveraged loans. So that's kind of where we are. Fiscal cliff will hopefully come and go, and markets will go up. But I think we're up about 4 to 4.5% through the end of last month, and we'll see how the calendar year ends come the end of the month. Any questions on October? Good. Okay, let me give you a quick update on Superstorm Sandy. The Comptroller's Office and the Bureau of Asset Management were in continuous operation throughout the storm. We had no heat, no power, no lights for probably 10 days, but we never stopped working. During the week of the storm, the cash desk raised $2.2 billion for the city, and we paid out about $350 million of pension payroll benefits. All the pension checks were funded, and everything kind of operated flawlessly, despite it being kind of chilly and difficult working in the dark. We talked to all of our managers. All the managers got through it fine. We talked to our real estate managers. All the real estate managers also got through it fine. There was a little bit of damage to a building here or there, but ultimately no material losses in any value in any part of our portfolio, particularly the hard assets being real estate. We have our eyes, we watch now on a weekly basis the potential increased needs of members who want to borrow against their pensions, and we're making sure that we've got liquidity in the system to meet that, and to date it hasn't gone up very much at all. We're looking at potential investment opportunities locally as a result of the storm, so we're talking with potential managers about mortgage loans in case FEMA doesn't come through, small business loans, real estate opportunities to rebuild workforce housing, as well as commercial properties that might have been destroyed by by Sandy, but as you know, we need to find the managers. We're talking to a bunch of managers. I'm optimistic that in some point in the future, measured in weeks as opposed to years, we'll come to the boards with some interesting investments, again, to put pension capital to work locally, all at market rates of return, risk adjusted. So if you have any managers that are looking to help the city, send them to the appropriate head of the asset class, because we've got some very interesting opportunities that have come out of this. With that, I think it was last month or the month before, we had an infrastructure educational session. Are those people here? Yes. We want to continue it a little further with people from J.P. Morgan Chase, who are going to walk us through a little bit of their views on infrastructure, and then we're going to talk about the real asset IPS. So, Petra, you want to get the...
Yeah, I'll get them
there. Bob, you want to grab that one book that's just sort of sitting there? I don't know. It may be. You know, Martin, we didn't go through the VCF's quarterly, VSF's. Oh, you're right. We have to, in and out of. Got it. Okay.
Thank you.
Thanks very much for coming.
You're very welcome. Thank you. Thank you for having us.
Thank you again for coming, and maybe we can start with short introductions and then go to the presentation.
Sure. We're here from J.P. Morgan. My name is Stephen Weddle. I'm a client portfolio manager at our Global Real Assets Group, which represents infrastructure and real estate investment strategies to investors. I'm joined today with our CIO from the infrastructure group, Jason Zabaris, who brings a tremendous amount of experience in the area. And today what we're going to do is essentially take 20 minutes of your time to build off of what Petya and Evan have already done as it relates to educating you on infrastructure from a practitioner standpoint of view. We're going to talk very briefly and refresh your memory of some of the key topics and areas that they've already discussed with you, but then also go in and talk to you about some of the risk as well as the mitigation of those risks as you start to think about infrastructure. The opportunities that we see currently in the marketplace, which we think is a very good time to be considering infrastructure for your plan, and then also then end up with some case studies to amplify those points. And then we'll have a question and answer session. So with that, I'm going to turn it over to Jason Zabaris to take you through the presentation.
Thank you, Steve. Thank you very much for your attention. As Steve said, we'll talk through in sort of fairly broad overview terms the sector, some of the considerations, the risks, the opportunities, how we look at the sector, and then we'll try and bring it to life with a few case studies of investments that we've made to give you the opportunity to understand more about what we do, but also to ask questions perhaps more directly about assets and what we do. So turning to the first pages 3 and 4, you see the illustration that shows subsector geography stages of development. What we're trying to do here is just show you the bookends of risk considerations. So when we look at subsectors within infrastructure, you have assets that are more or less risky, for want of a better word. We consider at one end regulated utilities to be relatively low risk, and at the other end infrastructure that's related to telecoms or infrastructure that has the risk of technological obsolescence or where its useful life is shorter. So infrastructure is essentially the assets that help society function, that have a long-term monopolistic value. In terms of geographical risks, Clearly, developed markets and emerging markets at each end of the spectrum. You have infrastructure demands in both, and the factors that fit into risk considerations there can range from political and legal risks, things like expropriation, but in a developed market, potentially regulatory risk and how the regulator deals with investment, return on investment. And then the final broad factor would be stage of development. Existing assets, or what we call greenfield assets. So greenfield would be assets where there's an upfront requirement to build or commission infrastructure and the risks associated with delivering that. Slide 4 just shows how we try to mitigate and manage those risks, managing downside but also delivering opportunity and investment return. As I mentioned, regulatory and political risk, that's quite important, but the key to it is transparency. So understanding exactly what, if you like, the rules of the game are before you make investments, and also having a regulator with a track record that you can assess how you're likely to be treated in terms of long-term investment return. Asset performance. Infrastructures are essentially businesses, and so having the appropriate knowledge, skill, tools and processes to effectively manage them is a key part of managing that risk. And then the final one I'll just sort of pick up on is the variety of risks within subsectors. And so you will appreciate that a regulated utility or a road or an airport will have different risks. And so key to investing is having diversity in your investment exposure. So moving to slides 5 and 6. Again, some of this you may be familiar with, but just as a refresher. At the bottom left, you have core infrastructure. This is at the low end of the risk spectrum. This is an investment where you would expect to receive the bulk of your return in the form of cash yield, so annual cash performance. At the other end of the spectrum, you have got opportunistic. This is clearly more risky and more dependent on the exit of your asset investment, so sales success. Moving to slide 6, this illustration just shows the range of risk relative to different subsectors within infrastructure. I think the 2 points I'll leave you with here is it is a very broad sector. Risks do overlap, but more importantly, no two assets are the same. Even within the same subsector, if you were to take an airport or a water supply system, each one has its own unique characteristics, and hence the review and understanding of those investments is critical to investment success.
Before you leave this slide, I'm looking at the list there. I mean, healthcare, there's money generated there, profit and loss, energy, water supply, waste collection, all the others. But schools, government buildings, military facilities, and judicial facilities, could you just expand on that?
Sure. Less in the US, but more globally, you have government-run programs where schools perhaps will be built and run. And when I say run, I mean
the construction of the school.
The construction of the school, the financing of the construction, as well as perhaps a 20 or 25-year contract to actually manage the facility, which would include sort of hard and soft maintenance. So making sure all the lights work, and making sure that the roof is replaced after however many years, making sure that the facility is fit for use.
Thank you.
On slide 7, this again just tries to sort of pick out a few of the risk and value drivers within infrastructure. And essentially, it's not particularly complicated. Your return depends at the top on how much demand you have. So the revenue factors. So, for example, if you have an investment in a toll road, how much gas costs, fuel price, will have a bearing on how much traffic there is on the road. Not necessarily a lot, depends on the road, but that's a factor. The next level would be costs. What it actually costs to operate the business. So again, nothing particularly complicated there. It's like any other business. The final part is what you have is the capital, which is what you have to invest. So if you're building a road or if you're improving a road, clearly managing the construction or a capital expenditure budget on time and on budget. Obviously, that's an important factor in determining investment success. So, moving on to slides 9 and 10. I'm moving quite quickly here because I know we're at a time constraint, but if there are things that, questions you have, please feel free to ask. So on slide 9, two things here to pick up on. The slide or the chart on the left just shows the rate of real GDP growth in the sort of what we consider the sort of Western developed world. And what you see here is growth rates are declining. So in terms of looking at long-term investment success, you have to be very aware that in the mature markets, the less risky markets, you face a slowing economic growth rate. Now, it in itself is not a problem. It just means when you make investments, you need to be very aware of the factors that can affect investment success. So if you have a declining population, for example, you have to think about that quite carefully when you make an investment, because you're making an investment for 20 or 25 years. And so if you have a declining population, you'll be spreading the cost of that service over a smaller base. So that's the kind of thing that we think about. On the right-hand side, this is a chart of inflation in the US over the last 30 years. It's important to consider inflation because inflation erodes value. So having an investment that keeps up with inflation is very important. And what you have within infrastructure quite frequently are mechanisms to increase your earnings, your cash flow, by inflation or potentially more than inflation. On slide 10, this really starts to cover where we see some of the opportunities. The first chart I'll draw your attention to is on the top left. This shows the US water system. In the US, there are approximately 50,000 water systems, but a lot of them are very small. More than half of them are in the sort of very small system, so supplying hundreds of people, not thousands. And there is a need, a lot of these systems were built 30, 40, 50 years ago, there is a need for replacement and renewal, and there are constraints in terms of the ability for local municipalities and cities to actually invest in water infrastructure. So this is an area where there is a need for investment. On the right-hand side, you see the chart here. It's called, it's the crude oil price divided by the natural gas price. It's called the Henry Hub ratio. And what this shows is the differential between the cost of energy from oil, or crude oil, or natural gas. And what you see here is, over the last 3 or 4 years, there's been a very big difference created. And all this is showing in the chart is the fact that most people in the US are very aware of. The abundance of natural gas has made that a very cheap form of energy, and this just shows how much cheaper it is relative to oil. We see that as an opportunity, and we're going to try and bring it to life a little bit with one of the case studies that we have in the moment. The final chart I'll just touch on briefly on the bottom right. This shows on one end natural gas consumption, and on the other end port volumes. So this is the amount of cargo going through ports. This chart is only meant to illustrate in numbers the fact that you don't expect going through economic difficulty to see a lot of variation in the demand of natural gas. People tend to heat their homes when it's cold, and it's not so closely linked to economic activity. On the other end of the spectrum, you have port volumes, which is a proxy for trade, and clearly when you have economic difficulties, you do see greater reductions and then recoveries of volumes. So, moving to slide 11. What does that mean? Well, we see the budget deficits in the US and the austerity measures in Europe creating opportunities. It's very difficult for governments, states, and local managers of infrastructure to fund replacement, repair, without either increasing taxes or increasing debt. So we see the opportunity for investment there. We see inefficiencies in particular industries where new capital can bring benefits to all parties. Higher interest rates, we think that's important because inflation, whilst it's not particularly high today, we believe that's something, certainly when you're looking 5, 10, 15 years out, you need to be very aware of and consider. Natural gas, I mentioned, it's changing the economy. Hopefully in the case study in a moment we'll show how much that matters. And then we also think it's a good time to look at transportation assets simply because of the cycle that we're in at the moment. Any questions? No? Okay. I've got 2 case studies for you, and we chose 2 that were quite different. One is a regulated utility, the other is a transport infrastructure investment at an airport, in fact 2 airports. So let me just tell you a little bit about Summit Utilities. Summit Utilities has a slightly different model to many utilities in the sense that it is a growing utility. It is growing because Summit Utility doesn't serve densely populated urban areas or cities. What it does is it targets, it gets permission, it gets service territories awarded from regulators to serve what's known as extra urban areas. So outside of the city, beyond the suburbs, less densely populated areas. And what the regulators do is say, well, we will allow you to charge a little bit more to reflect the higher cost you have of installing gas pipelines. And however, what we are doing, and the business model here is basically to convert propane users to natural gas users in that extra urban area. And you'll appreciate the sort of safety benefits of natural gas as opposed to large propane tanks. I mentioned earlier reducing GDP. The US, along with most of the mature industrialized world, has reducing growth rate, but this is a utility that actually is increasing in size, and as it does so, it actually brings benefits to its customers. We've owned this business for 5 years, and we expect to see it grow more and more over the next 5 to 10 years. It currently operates in 2 states, in Colorado and Missouri, but we're looking to grow in other states. Slide 14 just gives some examples of the service territories that have been added since our acquisition. We've installed nearly 2,000 miles of pipe. Yes?
One quick question. What is the attraction to the extra urban area to pay more for natural gas than propane? Is there a law change?
Oh, no, sorry.
Disallowing propane use in those areas? Or?
No, sorry, I wasn't clear. When you have a dense city population, the cost of installing network and serving each user is quite low because everyone's close together. The company charges more than urban areas. It's less than propane. So you have So what we're doing is investing capital, but also saving money for our customers. And if you look at slide 15, this is a chart that shows the effect of lower natural gas prices. So the blue bars are what the cost of heating homes, the average cost of heating homes in Missouri has been over the last decade if you were to use propane. The yellow bars are the cost of heating a home equivalent with natural gas, and you can see the economy has changed with the abundance of natural gas, but what it actually means is the average household can save approximately $1,000 a year in heating costs, and that is after we have built out the network, even though the cost of building it is slightly higher. So that's why we like this kind of investment, and that's some of the opportunities that we see. If you look at slide 16, you actually see what we have achieved over the last 5 years with this investment, and we'd expect to see that growth continue. And it goes without saying, 30,000 fewer propane tanks is probably a good thing. I'm going to move on to our next investment case study, unless there was any questions anyone had about Summit, and you wanted to know about that. No. Okay. The next one, so slide 18. Slide number. So this investment is actually comprises two airports. The airport of Cairns, which is in North Queensland, and Mackay, which is also in Queensland, but not quite as far north. They handle together about 5 million passengers. But what we liked about this particular investment was that whilst it is in a developed market, so the lower end of the risk spectrum, its proximity to Asia means that it benefits from a faster growing aviation market. So if you look at where Boeing and Airbus are selling more of their aircraft, it's into the Asian aviation market because it's fast growing. We like these airports because they're close to that market and as a consequence benefit from higher rates of growth. The airports are leased under a 99-year lease and we have complete liberty to improve the facilities and increase the profitability of the airports over the long term. So what we do, the main task is to grow passenger numbers, but then is also to make sure that the passenger experience, the service quality of the airports is high, so that the associated revenue, whether it's retail or parking, is also there for the benefit of our investors. I'll move on to slide 19. Again, shows on the map in Australia where these airports are. I think one of the risk factors I mentioned earlier was diversification. What we liked about this was it was two airports that had quite different traffic dynamics. So it gives you a balance, and it means you're not overexposed to any one particular type of traffic or one particular asset. Australia, like the US, is a relatively mature market, but notwithstanding that, we have actually managed to achieve growth rates in passenger numbers of 8 and 14% year on year. So some of that is due to recovery from the financial crisis, but it's also been a result of some very active management that we have undertaken to grow and stimulate demand. And you can see example 1 on slide 20, where over the last 3 or 4 years, you see where Cairns, this example is just Cairns rather than Mackay. You can see the routes that are served internationally, routes into Asia. We have been able to put on more routes by working with the airlines to increase demand, and whilst doing that, we've also improved the facilities at the airport. An example of the improved facilities, if you move to slide 21, shortly after acquiring the airports, we finished a construction or a redevelopment of one of the terminals. The airports together have 3 different terminals, so this was one of the terminals was upgraded, doubling the size of the terminal area. This is slide 21. Slide 21. And also finishing the project actually ahead of time and slightly under budget. So it was a $200 million project that needed to be completed, and we managed to complete that ahead of time and below budget. That's that kind of construction, that kind of undertaking you don't do every year, clearly. So with an airport or with other sort of transport infrastructure, that kind of investment you would do perhaps every 5 or every 10 years. But if you're owning assets for the long term, it's very important that you design and build in efficient and well-designed facilities to make sure that you're delivering customer service, but also making sure that you're delivering for investors the right kind of risk and return experience. So, I've been through that very quickly. I'm sure that there may be questions, so hopefully we have a little bit of time for that, and we might make it more interesting for you.
Any questions?
I have a question.
Yes.
If we think about the total universe of potential deals that we might look at globally as well as in the U.S., what percentage of those would be public to private? So, for example, a toll road that's owned by a state that we would then buy and take it private.
This is a big question. The universe is very, very large, so it depends. Some people include in the universe power and power facilities, and if you include that, then the proportion that would be from sort of privatizations would be relatively low, because that is a very big industry. If you look at specific sectors like roads and like airports, clearly the majority of road infrastructure, and perhaps not the majority outside the US, but clearly in the US, all airports, perhaps bar one or two, are owned by the state. So any sale of asset or lease of asset will be through a privatization. So there are, outside of the US, there are a lot of airports that are owned by private investors, pension funds. So there is opportunity for transactions to come up. But typically what you find is the owners of airports, when it's a pension fund or a fund on behalf of a pension fund, they don't really sell that frequently, because they're a good long-term asset, so those owners don't really want to sell them. They manage those assets to improve cash flow and yield to investment return, but they tend not to sell that much. But certainly, when you look at airports and roads in the US, and roads probably more broadly, they tend to be privatization. What that is a percentage of the total. It's a very hard question to answer, correctly. When I say correctly, then I'd have to give you sort of 4 or 5 assumptions to give you a meaningful percentage, and then it would be over some sort of time span.
That's helpful.
Okay, all right. I hope that answers the question.
Any other questions?
Great.
No, thank you.
Thanks very much. Good luck with your investment. Say? Yes. Actually, we're going to do the asset allocation discussion, but you should bring in the real estate guys. Yeah, bring them in so they can listen to Doug.
Sorry, Larry.
Bring in the real estate guys. I think we do your thing.
I'll pass it out.
Yeah, and I'll sit back at the table.
Got everyone. Go back.
In fact, I'll even clean up the table.
She's doing very well. Knock him out. Feed him in. I mean, it's
Very good while that should be.
Is that right?
Some special high pressure plants to play with.
Hey, Doug. Hey, how are you? It's good.
Right?
How are you? How are you? Yeah. They're doing that. The issue is
Morning.
Morning. How are you?
Good.
Thank you.
You hand down stuff. Go. You get one?
Yeah.
Yeah.
Are we ready?
Almost.
It's up to you.
Thank you.
So let's see. Okay. So this is the continuation of what we started, I guess, about a year and a half ago when we did our asset allocation. We talked about real assets. We talked about infrastructure as part of the real assets. And about a year ago, we set out to increase the STAM of BAM, and we hired a couple of people to do infrastructure only. And once they arrived, we set about to do the education of the boards, and now we're getting ready to do the IPS. And just again to put a little envelope around what we're going to talk about. So we have a 5% allocation to real estate. And as Doug's going to walk us through, we're going to expand the definition of real estate to become real assets. So you'll have real estate, infrastructure, other real assets that Doug's going to walk through, and then we'll get to how we allocate through that. But ultimately means we've taken the real estate IPS and expanded it to really be a sleeve within the real asset allocation. So I think the easiest way to do this is let me hand it over to Doug and let him do some asset allocation conversation. Then we'll hand it back down the table to the Steves to go through the IPS. So over to you.
Great. So as part of that natural progression that Larry just described, we were asked to look at what the policy impact would be of having, setting up this new policy where you kind of put a label of real assets on the umbrella that includes your real estate allocation, which you've been investing in for more than a decade, and this newer category called infrastructure. And so if you turn to page 3, I think, Larry mentioned, going back to the last policy discussion we had, we talked about, we focus on risk and return in the different categories that we have, evaluating new categories, thinking about the basket. And so as part of that general discussion, we talked about a lot of the categories on page 3. You have a dedicated allocation to tips. You raise that from 3 to 5%. We talked a lot about emerging markets bonds, but we didn't put an allocation in place in part because of the basket limit and where we were bumping up. You have real estate. On the public market side, you have REITs. You've got a 3% allocation there. We had also discussed commodities, which, thinking about the commodity futures market as being a potential other allocation we could add, again, dependent on movement on that basket limit from 25 to 35%, or some other change to the basket that moves something else out of the basket. A lot of the other things on the left-hand side, you get exposure to things like agriculture, energy, and some of these other, public infrastructure. MLPs are a kind of a niche strategy that a lot of people are talking about. But you get exposure generally to basic materials and energy through your equity allocation. You've got about 15% of your, Russell 3000 mandate has some form of exposure to basic materials, energy, and some agriculture. On the right-hand side of the page, you're very comfortable with real estate. In the energy space, it's really a subsector of your private equity allocation. You've got allocations there to managers like First Reserve, and I think there's a Carlyle Energy Fund in there. So you've started to kind of look at that as an opportunity in a return-seeking manner. And then as you go down the page, infrastructure really, in our minds, is a natural extension of what you've been doing both in the real estate and the private equity space. You're broadening your opportunity set, but you're also, as part of the goal of this entire page, you're seeking to kind of strike a balance in your portfolio regarding how it will perform under different economic scenarios, right? And the two big, kind of drivers of economic conditions are economic growth.
Thank you.
Our economic growth, and then the inflationary environment. And so in general, I think most of our clients, and we believe most public pension funds, are a little bit underweight to inflation-sensitive assets, and we've been advocating that clients take a kind of a holistic approach in all of these categories of thinking more about adding inflation protection, because inflation is so destructive to wealth and to assets. So there's some several pages here that kind of go through discussion about the different categories and then inflation. If you go ahead and turn to page 10, as part of this education process and staffing up and then rolling out the policy and then eventually an annual plan, the big question that comes up is infrastructure a separate category? Is it a separate policy category, or is it a subset of real estate, or a subset of real estate and private equity? And so in general, the way that we look at it is we see it as a subset of real estate or private equity. And again, it's going to depend. It's just like real estate, where you can have investments that are going to return 5 or 6% in the core space, and then if you have opportunistic investments that are more aggressive, in the development space, you're going to see kind of mid-teen returns. There's that broad spectrum. There's the same thing in the infrastructure space, and JP Morgan just started to highlight that at their different risk profiles for different types of investments. And so we really see it as part of an extension of real estate, and in some cases you can argue private equity in situations where it's energy focused. But if you were to try to consider it as a separate category, if you go to the next page, we've got the asset allocation table here with your targets. And what we did here as a kind of a pro forma exercise to evaluate that is to look as a starting point, if you thought about the idea of having a 1% allocation for the fire plan to infrastructure, and you're carving that out of that real estate allocation, what would be the impact on the expected return of the fund? And because it would take you several years at least to get 1% in the ground in infrastructure, we just use that as a starting point. Obviously, if you ramp up the program, you're going to have multiple opportunities to evaluate what the sizing is when you go through your annual plan and when we do additional asset allocation discussions. But for the most part, even though we use a separate return assumption of 7.25% for infrastructure versus the 6% assumption we're using for real estate, you can see that the impact on the bottom line is really negligible. It's a matter of basis points of 5, 8 basis points, depending on how you look at it. The correlation numbers we use are very similar to real estate, and that the infrastructure space we see as an opportunity to collect rents, if you will, on different types of assets. We collect rents on real estate right now, and that's a part of generating the return in that category. When you expand the opportunity, think about things like pipelines or other types of infrastructure, airports. It's the same philosophy. You're putting your capital to work in an effort to collect those rents and see and potentially see some type of inflation protection and also some appreciation. So I think in general, we view the category as something that should compete for returns, just like the rest of the portfolio. You want to get a market kind of return that is going to help you achieve your overall investment goals, but in the same vein, you're going to be adding more inflation protection. And that's all I had to kind of set up the discussion about the policy document, the first round, and then obviously coming up, I guess next year would be the annual plan.
Right. So again, so infrastructure is sort of a sub-asset of what we now call real estate, and real assets, and real assets is just real estate plus infrastructure plus future draft picks like timber and energy assets. Steve, you want to walk us through your presentation?
Absolutely. We have 3 different IPSs, and they're in your books, and I believe it begins on page 117. In addition, we've passed around a PowerPoint that looks like this. I'm going to work off of both of these documents, and because I have three, I'm going to move as quickly as I can. Feel free to interrupt me, but I'm going to move quickly. I compliment you on your decision to contemplate, consider the addition of other asset classes. We saw this movement occurring probably 4 or 5 years ago, where people wanted to get more asset classes like real estate that did the same sorts of things in the total plan. In our own base, if we have 75 pension funds, about 12 have moved and basically created a larger portfolio. And I was speaking to Steve and Bill, and I think you guys had a like or similar number in your base. So a good idea. I wanted to quote from you, and I think you had J.P. Morgan in here earlier, but one of my colleagues went to a conference, and there was some interesting things stated about real assets, and I could just share with you something that they said. This is their summary. History shows that secular changes in the investment environment force dramatic changes in asset allocations. Low bond yields, along with outsized equity market volatility and modest equity returns, have brought us to a new asset allocation tipping point. Global real assets, real estate, infrastructure, transport, and natural resource assets that can provide higher income than bonds and superior risk-adjusted returns to equities will increase in size and importance in investor portfolios. And in the next decade, we believe real assets will move from an alternative to a mainstream asset class. Portfolio allocations could rise from roughly 5 to 10% today to as much as 25% in the next decade. I wholeheartedly concur in those statements. I think that's the way of the world. I think that's the direction we're going. We crafted IPSs for you, and we did it a little bit differently this time. We created basically a global real assets IPS, if you will, and that begins on 117. But if you could take a look at my PowerPoint book, please. The main reasons to be in real assets are laid out for you on page 1 of the PowerPoint. Preserve investment capital, provide a hedge against inflation, diversify the broader portfolio by dampening volatility, and provide attractive risk-adjusted returns. The case doesn't change when you move asset class to asset class. That's the case for all of them. Diversification, page 2 of the PowerPoint presentation. I've laid out for you a variety of different asset classes, including infrastructure, real estate, bonds, stocks, etc. And I won't read this to you. If you just look, you have low or negative correlations to the other asset classes, and actually within the real assets, there are also low correlations, which is a good thing too. They don't all act the same. Page 3, correlation to inflation. Obviously, and I'll just use real estate as an example, if you view a lease as goods and services, when inflation hits, that lease costs more, and that is the overly simple way of stating this, but that's basically what we're talking about. And as you can see, the stronger the hedge, the green columns will take you through basically, but that's a nice thing to see, and it'll be nice. We've been in a low inflationary environment for a long time. It's not going to stay like that forever. Page 4, I just take you through. We mentioned risk-adjusted returns, obviously at the forefront of everybody's mind. I take you through listed infrastructure and then different types of real estate, the Opportunity Fund Index, the Value Added Fund Index, and the Odyssey Index show you real estate. Though we don't intend to immediately move in the direction of farmland and timber, etc., those are other real assets that are present in that particular study as well. A quick page by page on 117, we have laid out the strategic objectives on page 2 of the document. I'm sorry, at the bottom of those pages, it's page 2 of the document. The asset allocation, 6% plus or minus 2 to all real assets. And then responsibilities and delegation. These sections really have not changed. I've been with you, I think, 8 years now. I don't think they've changed in 8 years, so you've seen those before. One area that you might want to take a look at and read, page 5, exceptions to the IPS in the event something has to get changed. That's how it would get changed. And with that, pretty straightforward document. I don't think there's anything mysterious in that one. Not to say that there's mysterious things in any of the documents, but anyhow. Let me move to real estate. It's page 5 in the PowerPoint. Basically, years ago, as you know, we moved to what I call a no less than 40 program. No less than 40 of your assets, your investments are going to go toward core. and core plus, no less than 40 toward non-core, and we're going to try to tactically adjust with that 20% to the extent you can do that in a relatively illiquid asset class. We've made a couple of modifications, and I've highlighted them for you from modifications to your old IPS. They're in the book. Page 6 of the PowerPoint, please. We've changed the benchmark. As you're aware, this really isn't new. I would say, Larry, what was it, 18 months ago or so, I think we moved from the MPI to the Odyssey. The Odyssey is an investable index. It has leverage. It's just a more realistic benchmark. And we've subsequently changed it to now we're saying it's Odyssey net plus 100 basis points. The question arises, well, why is that a good number? Why is that fair? Is that transparent? Is that what we should do? And to help you understand that a little bit, if you take a look at the 10-year rolling returns, we created a hypothetical portfolio, 50% core, 50% non-core. And we ran it backward against the Odyssey. And as you'll see, it's very close, very close. So I think we'll be challenged in a good way to meet our benchmark. I think it's a fair benchmark. And obviously a benchmark is something we've changed. It took 8 years before we moved from MPI to Odyssey, but we can always reflect on the benchmark and see where it goes. Next page, page 7. This is a refinement. The way we used to state it in the IPSs was that from a diversification standpoint, we could be plus or minus 30% of the weighting that was in the NCREIF property index. Quite frankly, you could drive a truck through that. I mean, it's simply not a meaningful threshold. That means I could probably take you up to 75% office if I wanted to. We've refined that. Now we've put these up to 40, up to 35, up to 45. We just think it's a better way to do it. It's not our intent to push toward those limits. It's not our intent to deviate too much from the benchmark diversification. That said, we would appreciate having some flexibility in that regard. Debt limit. If you go back in time, as you recall, ladies and gentlemen, 8 years ago, the program that we instituted, there were some investments in place. They were higher returning, opportunity fund-like investments. And we immediately began to, for lack of, I don't think this is a word, conservatize the portfolio by creating a core portfolio within your real estate allocation. At that moment in time, more than appropriate to have a 50% LTV limit. We couldn't really exceed that at that moment in time. But what we found over time, and recall, we are tilting a little bit. We're tilting a little bit more non-core. We're going to do some over-committing, likelihood. And the reality is those types of strategies, they may carry as much as 75% debt. On your core side, you're never going to see more than about 35%. We're not going to push this limit. It's not my job. It's not my desire to ratchet up risk through debt. I don't want to do that. I also don't want to have to come into you every quarter and say, hey guys, it's 50% and we're at 57%. I don't know what your numbers look like this way when the downturn occurred, but I will tell you this, 50% doesn't give me any room if a correction occurs, because that'll throw up your debt limit. So if you assume a 60-40 split, at least in the near term, I think ultimately we go to 50-50. I think we'd be hard-pressed to get to 65, but we do want the flexibility.
Steve,
Sure. Sure.
So is the 65% leverage limit consistent with an Odyssey plus 100, or because the leverage is higher, should we be expecting a higher return over the Odyssey?
Sure.
During the course of putting this IPS together, BAM worked closely with Cortland and Townsend. Part of that exercise was a best practices component. So we had information available, probably about 10 Townsend clients and about 10 Cortland clients. So we had about, some important metrics like benchmark, LTV, and portfolio mix from these, like size, like-minded institutions. And so we found that on the debt level side, that there certainly was a range. Some of them had no debt limit, and some of them had 65%, like spot on where we're proposing to be, and then there were some that were kind of like at 60. But they were all primarily in excess of 50%. They either did not identify a cap at all. Some of them were exactly at 65%. So we did kind of go through the exercise of finding, different ways to kind of get to the same point. So we feel comfortable with the 65%. That's one aspect of our review.
And I'm comfortable with that as well. I guess that my question is more, do we need a higher premium over the Odyssey since we're now allowing greater leverage in the program? So should it be the Odyssey plus 150, 200, for example?
In that return chart that I showed a moment ago,
Yeah.
I think that's levered. So
Yeah.
it's a good question. You know what? I'll look.
Okay.
I'm very comfortable with 100, but you're right. I mean, if that was going to really drive us a lot, then maybe we ought to think about it. But right now, I think 100's good.
We had that metric too, actually.
We did.
We did have that. We had the benchmark, we had the portfolio mix, and the LTV.
Right.
And you could see that we were in the range.
Right.
That this was in the range of what other folks were doing. Do you want to comment on that, Steve?
Yeah, I would. I would. Only other thing I would add out is I wouldn't necessarily correlate the increase in leverage to the increase in risk. I mean, today leverage is on devalued properties to a large extent. So your LTV, it may be a little higher, but the risk levels, I would say, are lower because of the devaluation, and particularly in certain assets. So that correlates it. So I think the N plus the plus the 100 on the Odyssey is a very fair way to look at your portfolio.
Okay, thank you.
Page 9 of the PowerPoint takes you through some other new limitations. No more than 25% can be invested with a single manager, no more than 15. We've moved that downward, so we're getting a little bit more conservative and refined to 15% invested with a single manager. So that's good. Briefly, a page by page, under real estate program, real estate investment policy, we take you through investment operations. We take you through what core plus, and non-core are on page 7 of my documents. Investment classifications, the limitations and allocation ranges are stated on page 8, no less than 40, no less than 40 as discussed. Investment types, this is important. Real estate does include more than just private equity real estate. It can include some other things like debt, securities, things of this nature. We seek the flexibility from time to time to do those types of investments. On the following page, we take you through the property type limitations that we discussed a moment ago, and then also the restrictions on single investment size, investment position, manager, leverage, all discussed in the document. Some indications of how we diligence things, the performance objective, pretty straightforward. A lot of it you've seen before. I just wanted to make sure I highlighted in the PowerPoint what we've changed since the last IPS publication. Moving on. Infrastructure. I know you had to talk about this morning. We've been before you. The talk this morning would be 3 different times where we've come in and we've talked about infra to you. We had an educational 101 discussion. We came in and we did a strategy piece. So I'm not going to go through what it is, et cetera. You know what it is, obviously. On page 10, this program, as it's launched, I believe will be a very conservative program. We've slated 60 to 100% to be in core infrastructure. And on page 10, we lay out that allocation for you. Again, on page 11 of the PowerPoint, we're going to take you through the core and non-core and what that means, what it means in terms of those thresholds. Importantly, on page 12, we line up, and basically I think this is a pretty good guideline sheet. Just takes you through exactly what this program will look like. The allocation ranges are obviously highlighted there. The diversification, the investment structures, obviously you can do funds, separates, direct, although I anticipate in the beginning it will be funds for sure. Asset type diversification, that's going to go to the issue of brownfield, greenfield, and what those two things mean. Again, a concentration limitation for the general partner is listed, a single investment size, fund lives, leverage at 65. Understand too, in infra, don't be surprised if we come to you with a core infra deal and it has 90% leverage on it. Infra is a little bit different this way. They can put debt on these. It's different than real estate, I should say. I was a little bit surprised by it. But generally speaking, I think we can cap this at 65 and be safe and comfortable. I wanted Ishka to talk a little bit about the benchmark we selected for the program.
Sure. And the benchmark, the proposed benchmark is the US CPI plus 4% over a rolling 5-year period. We also are targeting net returns of 6.5% for the infrastructure program. The proposed benchmark is in line with one of the strategic objectives of the real asset program, which is to achieve some kind of inflation protection or hedging from these investments. The benchmark being proposed is also appropriate for a core-based infrastructure program. A minimum of 60% of the infrastructure program is going to be targeted to core investments. These investments will be made in operational assets that have long-term steady cash flows and can generate an income yield. The proposed benchmark is also consistent with peer practices. There are several examples of institutional investors that have adopted a similar approach to benchmarking their infrastructure portfolios. Within Townsend's own client base, we can provide you with several examples of clients that have adopted a very similar approach to benchmarking their infrastructure investments. There's also return history to back the returns that have been used to target the infrastructure program with across public infrastructure and private infrastructure. So if we look at the gross nominal returns that have been generated within the infrastructure asset class and adjusted for inflation and fees, we get to approximately a 4% premium or a 6.5% net nominal return.
Thank you. Very quickly, I'll go through it's page 13 of the real estate investment policy statements. Again, I've highlighted most of this material in the PowerPoint for you already. The allocation ranges are found on the second page of the document, 60 to 40% on the core side, 0 to 40 on the non-core side. We discussed pacing. Risk management, a nice list of how we intend to control risk in the infrastructure program, which, as I'll reiterate, is intended to be a conservative program. The investment and evaluation criteria, very similar to the way you would underwrite and diligence other real asset classes like real estate. The performance objective is laid out for you as well. And then we put in, because this is a newer asset class, we put in a glossary of terms for you there as well. That concludes my formal remarks regarding the IPSs. I strongly recommend that you can contemplate the real asset approach. It's a good asset. It's a good way to go. It's being consistent with what your peers are doing. Adding a new asset class is solid risk-adjusted returns, helping you to diversify more. And I think it's the first asset class. I think probably, and I don't know what the time is I'd love to come in and talk to you in a year, 2 years, whatever, timber, ag, and things like that too. But we would recommend that you pursue this.
So, we got this draft. I asked Steve to do a little work on taking the Odyssey, which is the real estate benchmark, and trying to put it into some more digestible terms like inflation plus something, and as well as to track how it actually does relative to inflation. And it turns out the 10-year Odyssey return is 6.7%, and the CPI plus 400 basis points is 6.6%. So it's miraculously spot on. And the since inception Odyssey is 8.3%, and the CPI plus 400 is about 8%. So the Odyssey is being real estate only. Does translate to something like CPI plus 400. So what we're going to recommend is that the benchmark for the entire real asset category should be CPI plus 400, which, is, again, we're trying to keep up with inflation and make some money at the same time. And we're going to update this IPS to put that somewhere. But what we'd like is some discussion of the IPS, if anybody has any comments. Otherwise, we'd like to adopt this, and we can always amend it in the future, because it does, these things you don't just put on the shelf. And then, slowly we'll start looking at some infrastructure fund investments. We don't have the staff yet to do direct investments, but then again, we don't have the staff to do direct investments in any asset category, so there's no reason to do it in the newest one first. Any questions of any of the consultants about infrastructure, IPS?
Question on the Odyssey benchmark comparison. What's this inception date of that Odyssey benchmark? Do either of you know approximately?
Do you know the exact year? I don't. I know the MPI. I think was in.
Odyssey started in 2005.
Okay.
So kind of a low and declining inflation environment over that since inception holding period.
Yeah, since 78.
78.
Yeah.
I was going to say it's longer than that.
Yeah, it's longer than that.
Okay, so there is kind of there is a bit of a stress testing period in that time span in the late 70s when Volcker was jacking up interest rates and inflation was high. Okay.
First of all, I want to thank everybody for doing a great job on putting this together and educating the board. So I think we're all very excited to get started on this new sector. The one thing that jumped out at me here is that I don't actually see how much we're going to have in infrastructure. What's the, if we have a real assets allocation, what's the minimum or the maximum we want to have in infrastructure versus real estate?
I think it's set up that there's no mins or maxes. If you look at the 5% to real assets and you sort of, in general, say the assets, be it infrastructure, real estate, or timber or other real assets, are all kind of designed to get you the same CPI plus 400. And if you look at the nomenclature of infrastructure, core, core plus, optimistic, which happen to be the same as the real estate, I don't think that we'd recommend any specific target, because I'm a little bit like we have a machine that's kind of up and going for real estate, and the real estate allocation is sort of at a point in time, set up a certain way with a long-term goal in mind. So I wouldn't want to freeze that at all. But I think we'd like the flexibility to kind of, as we get infrastructure investments, as we get new real estate investments, you just kind of ramp it up without any sort of subcompartments. I think we're sort of halfway through, and I can actually tell you the exact number. If I look at the 5% that we've got allocated to real estate, which is now going to be 5% to real assets, we have 3.5% in the ground in private real estate. So we have 1.5% left in theory. And it's, we're just starting our deal flow in infrastructure. So, on the outside we have 1.5% if we put it all into infrastructure and turned off the real estate clock. But the answer is we're not going to turn off the real estate clock. So it's, it's the next 1.5% before we sort of go back and say, all right, well, do you want to do more than the 5? There's some mix, TBD, based on the deal flow between real estate and infrastructure.
So are we then maybe controlling it at core versus non-core at the total level?
Yeah.
So
well, it's sort of a 50. It's sort of a 50-50. It's
Okay.
kind of buried in each of their different sub-IPSs, I guess, the easiest way to say it, right? Because you've got the 40-40-20 going on in real estate, and you got the 50-50-ish.
Overall, we put 50-50 and 60-40 basically in info.
Right.
And can I just ask a couple of my other questions?
Go ahead.
Before we go through? I think one of the reasons that we wanted to get into infrastructure in the first place was the long stream of cash flows, which is a better match to our liabilities. And I don't necessarily see that as being one of the strategic objectives of real assets. And so is that something that it would be appropriate to add?
We could add it. The problem with not the problem, the reality is, and this is something we should, as the program develops, discuss. which is the wrapper that infrastructure comes in now, I would tell you, is not the ideal long-term wrapper for a pension fund. Let me try saying that differently.
I know what you mean, because
So you have a 30-year asset, which is a great asset for us.
Right.
If we owned the Brooklyn Bridge, maybe not Brooklyn Bridge, doesn't have a toll. If we owned the Triborough Bridge, which has nice tolls on it.
We do own the Brooklyn Bridge, I think, don't we?
We do. The city does.
Yes. I hope so.
I can sell it to you. So if the city bought a bridge, let's just call it a bridge, and owned it outright, that'd be great. We'd have 30 years worth of cash flow and then sell it at the end and have a terminal value. The problem is if the way we're going to start investing is we're going to invest in funds like private equity funds that have a finite investment period and a finite realization period. So you miss the great match of assets and liabilities. Ultimately, and I would tell you this is ultimately, ideally, for both real estate and for infrastructure and for timber and for farmland, a fund like ours is supposed to have the talent and the financial resources to own it directly. So we're supposed to own office buildings, we're supposed to own toll roads, we're supposed to have the staff that can handle that, but that's not today, and it's not really in the IPS. But it is what some of the bigger funds do, as you know, the Canadians in particular, the Canadians, the Singaporeans, the Chinese, and the Australians, they own these assets outright. But again, this sort of so you're correct. That would be the right thing to say, but it's just not the way the things sort of set up. But we were happy to put it in. It's definitely an objective.
Right. And if you put that in as an objective, then that leads you to the type of structuring of the deals that we look for.
Yeah.
So we are going to then be led into longer-term deals, more partnership sort of arrangements versus finite funds.
We can easily put that in.
Yeah, that would be great.
No reason not to.
Okay. Can I keep asking questions?
Does anyone else have questions? Well, I think that you should go ahead.
Okay. So I want to think back to the answer that I got from J.P. Morgan when I asked about the public-to-private deals, because I want to make sure that we're not limiting ourselves in what we can invest in infrastructure by a sentence in here where it says the fund will not entertain investments that have the potential for eliminating public sector jobs. I mean, it seems to me if we want to invest in toll roads, for example, that are owned by states or municipalities, that you buy those, you take them private, and that naturally eliminates some public sector jobs. So to have this, we will not entertain investments, basically says we won't even think about investing in these things, and that really limits us in terms of what we can really do in infrastructure. So I wonder if there's a way to make this language omitted or change it in some way that, the only thing we're investing in is like utility companies, for example, in terms of infrastructure.
I think that language is in all of our IPSs. It cuts across everything we have. It's hard to take out, but I'll defer to others.
Speaking from the fire officer side, we would be very concerned with any investment that would eliminate union jobs. So I think that's probably one of the caveats that in speaking with the controller's office that we asked that it be in there.
And I do understand your concern, but based on what we're hearing about this new asset class that we're getting into, I don't know how we invest in it in a diversified way with something like this in the
I don't have the answer to your question, but we are concerned about impacting jobs.
Yeah.
And in the past, we've discussed this. Governor Cuomo had an infrastructure plan that he had presented and kind of fell by the wayside. There's nothing more happening with that. And like Jake just stated, we asked that question at the meeting. Will these be union jobs? And New York area, and we were assured, yes, they would. Obviously, if it were not 100% union jobs, would we compromise? We don't know that.
This is pretty broad. It says, not entertain if they even have the potential of eliminating public sector jobs. So it doesn't even say they will eliminate, it's the potential.
Well,
So that could potentially be anything.
We represent, Ken.
Yeah, I know.
And, unfortunately, we can't put that on the table because we may as well close our doors and go home.
Yeah, no, I understand. I just, too, I think we need to think about it from a fiduciary perspective, because our role as fiduciaries on this board is to get the best risk-adjusted return.
Absolutely.
That's our very first, tenet of how we make investments. And then we look at these other things that are desirable, like the job issue. And if we can find an equal investment that doesn't eliminate public sector jobs, then we would prefer to invest in that versus the other one. But this language, as it is stated, I think we need to consider softening it a bit, because it really is a very hard line and seems inconsistent with what we're all trying to do.
Could we go off the record just for a second?
I just want to say, obviously, as previously been raised, this policy has been in our other investments. I believe this policy was already adopted at least one of the other boards, and we are always going to make an investment that has the rate of return that the consultants approve and the trustees ultimately approve. So I don't think that including that in the policy will take away from our returns, and everything is going to be vetted by staff, consultants, and ultimately approved by the trustees. So the numbers are going to have to make sense to invest in it. And the fact that another board has already approved this statement, we're trying to maximize our reduction of fees, and we're trying to, invest in the same funds, or possibly in the future in the same direct investments. So I think, we're trying to stay consistent with our past policy statements and with the other boards.
And there is a statement in here that says all of this is subject to the exclusive benefit rule. So that's the overriding principle.
I'm just going to bring that up. We've had these conversations with other boards, and that exclusive benefit rule is consistent with what we've done at other funds, and I think that there's nothing in this policy that's inconsistent with the fiduciary obligation that this board has, that our office has. And I think, as you point out, Janice, the exclusive benefit rule language has been discussed at other boards, and you're aware of it. So I think that we should move on.
Yeah, we agree with the UFA and the Controller's Office. We're prepared to move ahead.
Me too. The other question that I had is related to this issue. So when there are opt-outs, I think we put something in our private equity policy that says that we'll get reporting to the board that tells us about opt-outs as a result of some of these clauses. So for whatever reason, that language didn't make it into this IPS. So if we could just add that, that would be terrific.
There's something about conforming this to the private equity IPS relevant topic, correct?
Right, reporting of opt-outs.
Reporting.
Reporting of opt-outs.
Okay. So subject to those couple of changes, can we get this approved? Yes, Bob.
Just one purely technical suggestion on page 121 of the book, page 5 of the policy. In the last paragraph, the third line, which is about urgent matters and the board being informed in writing or via electronic mail, it says that a documented phone vote granting the exception may be obtained. I'd like to suggest that in order for the board to avoid violating its own policy, you might want to allow for a documented vote, not just a phone vote, so that you could use email and other things. So removing the word phone, I think, would make it more consistent with the objective of the statement.
We would just say a documented vote. Granting the exception.
Yes. Good idea, Bob. Okay.
We made that change yesterday.
So you made it already, okay.
Okay. Can we approve this subject to the changes we just agreed to? Need a motion?
Yes, we need a motion.
Motion to approve the investment policy statement for real assets with the changes as discussed.
Second. Any objections? Hearing none, the vote is passed.
Thank you all very much. That ends the public session of the pension fund.
Thank you, Larry. That's all right for the second holidays. Do you want to do the variables first so that we can go in public session?
Yeah.
Go back and forth.
Yeah.
So
Yes, I was just trying to end one day to the other. Yes, sir.
We need a motion to move out of the public session, this meeting, and start the firefighter's variable supplemental. So moved. Is there a second? Second. Any objections? Hearing none, the motion is passed. Okay. We need a roll call, trustees?
Call the trustees. Janice Emery. Mr. Larry Goff.
Present.
Mr. James Sutton.
Present.
Mr. Robert Straub.
Robert Straub?
Present,
I think he's present.
No one hurt.
And we'll hold this proxy until he walks
We need a performance review of the firefighter variable supplement fund.
Okay, so we're looking at the September quarterly review for firefighters. We have extra copies if you need it. I'd ask you to turn to page 3, which shows that the firefighters VSF as of September 30th had $428 million in assets. The returns for the quarter were quite strong as we described for the larger fire fund. The return was 473, slightly behind the benchmark of 505. The return for the year was a very strong return of over 21%, just behind the policy benchmark by 16 basis points, and the 3-year return is over 10%, nearly 11%, and ahead of the policy benchmark. And for 10 years, the return is nearly 8.5%. The next page shows the asset allocation. The asset allocation is a bit more simplified or compared to the larger fund because of the need for liquidity. The asset allocation differences that you see on bottom will be dealt with when we pay the benefits in the next week, and the benefits that we will pay in the next week are available. There's ample liquidity available for those benefits.
Do you have a number on it?
Approximately $55 million. When we get closer to the date, I can get you an exact number. I don't know if Bob has anything on him, but I believe the number was approximately $55 million.
Yeah, I'm not sure exactly what it is this year, but it should be in that vicinity.
Right. So the asset allocation will not change because of that. We do have ample liquidity throughout the fund for it. Next few pages show the allocation and management effects. The allocation and management effects are less muted than the larger fund because of the fewer allocation, the fewer differences, less cash that we held, and also the large benefit payments that we pay on a yearly basis. The summaries are shown on pages 8 and page 9. For equities, it's actually quite simple. Page 11 shows a summary. 70% is in equities, just under $300 million. The vast majority of it, in fact, the majority of the fund, 51%, is in U.S. equity. The entire allocation is passively managed versus the Russell 3000, and as expected, the returns virtually mirror those returns of the Russell 3000, off by just a few basis points. 6.2% for the quarter and over 30% for the year. The EFA and emerging markets are, in fact, actively managed. The EFA represents 10%, and the returns were 648, behind by 44 basis points for the quarter. Very strong returns, 16.5% for the year, nearly 300 basis points ahead of the EFA benchmark. For emerging markets, that represents 3% of the fund. The return was 5.5%, but that was below the the emerging market benchmark. But for the year, the return on an absolute basis was high, but still below the policy benchmark. The return was 1582, behind the benchmark of 1733. And lastly, on the equity side, we have REITs, which was roughly flat, as you see. But for the year was extremely strong, returning over 33%, over 100 basis points ahead of the benchmark. Unless you have any questions on the equity side, we have fixed income, which represents about 30% of the portfolio, and 2/3 of that is in the investment grade portfolio. Page 18 shows a breakdown. And the managers did outperform in each of the sectors. And in fact, on page 19, you see the returns, and 4 of the 4 managers, every one of them outperformed. The result was a return of 239, 35 basis points ahead. The return for the year was 7.01%, 50 basis points ahead. And the return for 3 years was 8.05, also well ahead of the benchmark. The return for the longer periods were also ahead, and the volatility was lower than usual, below 3%. TIPS represents 2 to 3%. The manager, PIMCO, here outperformed by 26 basis points for the quarter, returning 238, and returned 989 for the year, 79 basis points ahead, and was also ahead in the longer term since inception. Enhanced yield, as you know, we did a transition. For the quarter was slightly behind, returning 321 versus the 412 for the benchmark. For the 1 year, the return was 1566, behind the policy benchmark of 1784. Longer term, we're ahead of the benchmark, and when you go out to 10 years, the return is nearly 9.5%. Told you what the estimate of the benefits are that are going to be paid next week. Other than that, are there any questions?
Any questions? Okay.
Did you state the benefit payout next year?
About 55.
Oh, okay.
Okay. Got it? Yep. Good. Any other questions? John?
No. That's all we have.
Okay, then we need a motion to move out of the public session and close the firefighter variable supplement meeting.
So moved.
Start fire officer variable supplement meeting.
So moved.
All right. Let me get it.
Motion to accept the fire officer's quarterly review of performance of the variable supplements fund as stated in the Controller's Office memorandum booklet.
Second.
Any objections? Hearing none, the motion
On that, we just have one question. Our anticipated payout for this year is around 21 million?
I would expect it would be closer to 25 million. I would not have the amount for another couple of weeks, but that's my estimate. Bob, do you have?
I don't have a better estimate. The 20 to 25 million is the likely number.
Right. That's our expectation to be roughly the same as last year.
Thank you.
So if you turn to page 3.
We never did the roll call for fire. People are moving so fast. I mean, let me do a roll call. Janice Emery.
Present.
Larry Sloss. Okay, all right. Funny. James McGowan.
Yeah.
John Dunn.
Yeah.
All right. Now we have a quorum. Did we do something out of quorum? I think we did, didn't we?
I made a motion to
Exactly.
accept the quarterly review performance presentation of the fire officer's variable supplement fund as presented in the Controller's Office memorandum booklet.
Second.
Aye.
Any objections? Hearing none, the motion carries.
Thank you.
Now I think we need a motion to move it into executive session.
So move.
So break down the cameras. Yes. Get lunch. Right. The program. Okay.